Today on Tony Talks, I'm going to be joined by attorney Carl Zellner and CPA Gary McHenry. Our topic of discussion today is going to be taxation on the sale of real estate. We're going to look at when real estate is treated as inventory or capital asset, long-term versus short-term holds. We're going to look at the basis of properties when you're selling them. We'll also look at ways to avoid or perhaps defer income tax on real estate. So maybe looking at the primary residence exclusion and things like 1031. So let's get into it. So a lot of the clients that we have here at Anderson specialize in real estate, investing in real estate. And so one of the questions that I'm asked a lot is, well, what's going to be the taxation when I sell this piece of property, this piece of real estate? And that's a very open-ended question, wouldn't you say?
Oh, it most certainly is. When you start looking at that, you first want to understand what assets do they own, then how do they want to grow those assets over the life of the asset, so it's where it needs to be for the time of transfer. Mm-hmm. But then in doing that, setting up the structure, you want to make sure they can maximize the income or growth of that asset and maybe be efficient with the tax. We don't want to end up with it and maximize the tax and take away the cost benefit of the asset. So it's very important to understand that an entity structure plays a big role in owning that asset. Real estate, whether it's what type of entity it's going to be in, where's that income going to flow? We want to take a look at, the long-term plans. Are we going to be doing flipping, short-term holds, rent to hold? So you're going to hold that asset a long time?
Well, that's actually a really good point. And that is a lot of the time where I like to start, right? So what are we doing with this real property?
That's correct. I mean, that's where you start because you understand the assets of that person. Mm-hmm. You can then take that beginning and plan with them where they want to go.
Right.
Because that's the next step. Mm-hmm. Because they want to grow, they want to add assets, they want to build their portfolio. So that's where we have to talk to them about the different type of tax planning, tax entities they can use, and then tax flow so that the income flows so that we can maybe do a best plan.
Well, let's look at flipping. Buying and improving and then selling of real estate. So with flipping, right, you're going in with the intent. You're purchasing the property with the intent to sell it. And that makes it inventory.
Yes.
So that right there tells you off the top how that's going to be taxed. Now, not how much tax you're going to pay, but it's going to tell you the actual type of tax you're going to pay, if you want to elaborate on that.
Sure. That's where we take a look at a property as becoming an inventory held for resale mm-hmm. versus an investment property. So when you're in flipping and you're buying that property, everything you spend, all of the costs of acquiring that property and then rehabbing it, getting it ready for sale again, those become the inventory costs that will be used as your basis in that property to offset your proceeds on the sale. And that's how you determine your gain on that sale. And then it becomes ordinary income to you because flipping is an active business. Mm-hmm. So you know what type of income that's going to be. So then you can plan, if you have the proper entities in place, on how to utilize that income within your structure. So that kind of summarizes, I think, flipping and the planning of the use of the income once you sell the property.
Now, one of the questions I get a lot when it comes to flipping is, hey, I purchased this property, let's say in 2019. I put, $100,000 into the property. Now it's 2020. I'm getting ready to do my 2019 tax return. Can I deduct anything out of the expenses that I put toward improving that property that I have not sold yet?
That's a good question. I get that a lot because they do buy the property in one tax period, flows mm-hmm. through to the second tax period. So they're wondering if there are any expenses that can be deducted on a personal return, say on a Schedule E, versus inventorying all that cost and utilizing it at the point of sale.
Or maybe even Schedule A. Property taxes and...
Sure. And I agree. That comes down to the point of what really is your purpose of that property. Mm-hmm. There are times when it becomes a short-term rental because maybe it's had to be held for a little bit longer. So if you do turn it into a rental, you might want to take a look at expensing maybe some utility expense, property tax expense, things that you do normally see on a Schedule E rental form on a personal tax return. In most cases, if it really doesn't provide great benefit because it might be a passive deduction or something like that, it might be better to leave it as inventory costs to minimize your gain on that sale. Right. So you do want to make the right decision.
But we're really just talking here, okay, I'm doing a short-term rental, but we're talking purely utilities, property tax. Maybe I did use a lender financing, so we're talking about mortgage interest here, that kind of thing. But all of the improvements, just to be very clear, all of the improvement costs and things like that, that all goes to the basis of our inventory, and we're not actually deducting or depreciating any of that, correct?
That is correct, because what you want to look at it is operational, which would be your rental period, versus inventory because it's an asset held for sale.
Right, absolutely. So all of those get suspended, for lack of a better word, until you actually sell the property. Because again, IRS really big on intent. So if you purchase that property with the intent to sell it, it is going to be inventory, not a capital asset. So even if you did a short-term rental, your intent is still to sell that property. It's not a capital asset. You cannot depreciate it. That
is correct. When you look at it on a balance sheet, it's in your inventory, your short-term assets. It's not a capital asset for that purpose. None of the costs are recorded in your P&L. Right. They're all up on the balance sheet.
Well, now, in that same vein, you can actually change your intent for the property. Maybe I purchased it with the intent to sell it, and I changed my mind. I decided I wanted to let the asset appreciate, and in the meantime, I actually want to hold this out as a rental property. I plan to do that long term because I saw that fair market value of rents right now really good, so I changed my business plan. But you actually have to do that. You have to change the business plan, right? It has to be legitimate. One case that one of our partners, Toby Mathis, talks about is the guy purchased the property with the intent to sell it. He changed the intent attempted to change the intent, I should say, by holding it out for rent. But what he did after that was where he kind of stumbled. And what he did was he'd go back year over year for, I believe it was 10 years. I think you're familiar with this as well.
10 years, you're doing environmental studies, things like that.
And actually trying to see the viability, if you will, of actually selling the property in that year. So he proved that his intent year over year remained as the intent to sell the property.
So I also think these tax items are incredibly interesting as well. But as soon as I heard inventory and intent, a little red neon sign started going off in my head about dealer status. So depending on what you're doing, the type of activities you're doing, you want to make sure those activities are situated under the appropriate entity.
Well, yeah, that is a very important point you bring up. And dealer status can have several pitfalls. One of them being that now that you're deemed a dealer, you're going to be subject to self-employment tax. You're not going to be able to do 1031 exchanges. You're not going to be able to sell on installment, if you want to add to that.
Yeah, I think the tax effects of that not only affects the classification of an asset you hold, it could be important by the entity you're going to use or where that income is going to be recognized. You certainly don't want to add self-employment taxes to a sale of an asset that would be just general ordinary income on your tax return flowing through from the sale of that asset on a Schedule D or a 4790, well, Schedule D in this case. But if you add SE tax to that and you add that nice 15% tax on there, you've taken away some of the benefit of your status as the flipping business is concerned. So you certainly want to understand where you're holding those assets, how that income is going to flow, and be very cautious in how you document that. Use your business meetings, I think, to kind of cover your intent and discuss your intent in those meetings that we are in this for the business of flipping this property, and make sure that you document all of that as you go so that you can have your best foundation of documents to kind of defeat the dealer classification.
When it comes to dealer status, I look at it and it's really like the frequency in which you're doing it. It's is this your main business? Is this your bread and butter, if you will? This is what you do to earn a living. When it's frequent, when it's regular, that's when we need to look at moving that activity into a different business entity. Usually at Anderson, we're looking at a C or an S corporation. Do you want to talk about which one you prefer? But
I wish it was more complicated than this, but corporations are one of the entities that simply avoid dealer status. It really depends on what you're doing in your individual scenario when a C or an S makes which one's best for you. And by the way, depending what you're doing in your daily life or how you generate your income, may be appropriate to have both. I really like the C corporation as a personal preference, especially if I'm talking about making a significant amount of income and the ability to control what hits my 1040 or my personal return. So I like the ability to turn the water spigot off, if you will. However, there's some incredible benefits if you're in an income range through the S corporation where you're getting benefits from the Tax Cut and Jobs Act and the qualified business income deductions and things like that make it beneficial as well. So as far as preference, it's sort of like, I look at it like a toolbox. Probably not going to use a hammer to fix my toilet if it's got a small leak. So it's really what is the right tool for the job is the way I look at it. What I know is, as y'all talked about on the dealer status stuff, is I don't want to be tagged as a dealer because you're right. Because of course I lose the ability for number one of getting passive income off my real estate. With the self-employment tax, we start looking at things like no more long-term capital gains as well. And you also have to look at, can I technically still do an installment sale? I can. I, as the seller, though, don't get the benefit of it. What you end up creating as a dealer if you do an installment sale is phantom income, meaning the price in which you're selling that piece of property for is immediately taxable from the full amount to you, versus if you're not a dealer and then the taxable income comes in as you receive it. So that being said, I think mentioning that long-term capital gains go away with dealer status is a good segue into long-term versus short-term.
And I also
as well
don't recall if we actually did mention that you lose the ability to take a depreciation expense if you are deemed a dealer. So very good points. I'll point you to watch the C Corp versus S Corp video on the previous installment of Tony Talks. And that can kind of give you a little bit of an idea of whether you want to go C or S when you're calling in to discuss those types of things with us. But yes, let's go ahead and talk about the sale of real estate when it's a capital asset. So when you're using the real estate for business activities such as rental property, what's the taxation on that then? Does it depend?
Well, it can depend, but as a rental property, it's a business asset. So as you use that through its life and then come to the point of having a good offer, you sell it. It gets reported then on a Form 4797. So that will come through to you as a capital gain on that sale on that asset. So because you've used it as that capital asset, you've got depreciation recapture to figure in, but that will certainly come through that form.
And you mentioned it's treated then as capital gains. What's the benefit of that?
Well, certainly the tax rates, if it's ordinary income and you happen to be in a 35% tax bracket and you can sell that asset instead for a 20% tax rate, or based on where your adjusted gross income ends up or taxable income, you could have a 15% tax rate. Some people even achieve a 0% capital gain tax rate. So those are all advantages over your normal or current personal tax rate, which could be anywhere from 20 to 37. So we have those advantages there by creating the capital gain tax for an asset and maybe taking advantage of a much lower rate.
Yes, and those rates are the 0, the 15, the 20.
20, yes, ma'am.
So yeah, I get that question a lot is, well, not that particular question, but how can I avoid capital gains tax rates? And my only thought is, well, you mean the more favorable tax rates? It's like that, you're in the best area there. And so we actually want to get you to where we are talking about selling a capital asset so we can take advantage of those more favorable tax rates.
I agree. I think some of the questions we get, I think people get confused that the sale of that type of asset will not only hit their ordinary income and be calculated in there, but then they get it what they think of maybe a capital gains tax as an add-on. And that's where I see some of the confusion is because then they're going, well, how can I eliminate the capital gains tax? And I'm going, it's not a question of eliminating, it's which one is better in how you're running that asset. Where do you want to end up?
Absolutely.
Because the calculation on the tax of your various income types goes through a schedule, and your ordinary income does get taxed at your ordinary rates, but your capital gains assets and those gains from those sales is taxed only at the 20, 15, or 0. They're not in both calculations.
Right.
So that's an important point for some people, I think.
So we talked about the sale of inventory, sale of capital asset. What about the sale of a primary residence?
Well, we could start there, of course, with how long you've lived in it and getting the exemption under Section 121. That's a very important law that was passed. I think that's helped a lot of people where property appreciates in a great amount because each person, each taxpayer would get a $250,000 exclusion, which for a married couple can add up to $500,000 of appreciation gain on that property not being taxed. So when you're selling that personal residence, it is going to flow through to a Schedule D as a capital gain, but having that exclusion can, if you do it in the right way, you can plan on that to minimize the tax effect on that personal residence.
Absolutely, 100%. One of the things that I believe it's Clint that talks about it is perhaps you want to change your primary residence into a rental property. You don't just, well, you can, but for tax purposes, it's not the best idea to just move out and put the property on the market. One strategy, if it's worth it to you, that you could use is to actually use an S corporation. S corporation being not separate taxpayer, but a separate entity. You could actually sell your primary residence, take advantage of the primary residence exclusion on your personal tax return. You get the step up in basis from the sale at fair market value to the S corporation. So you get that step up in basis, you get a higher depreciation. So that's just one strategy of utilizing actually that primary residence exclusion to convert your property into a rental property in the S corporation. You guys have anything to add to that? Am I missing anything?
No, I mean, that's a strategy. Certainly you want to make sure you're then begin renting it, because once you begin renting it, it'll have income that flows through. And you can even look at potentially, once you've rented it, you can then start to look at things like 1031 exchange if you want to exchange it into other properties. I always think of 1031 exchanges because a lot of times, or a lot of folks who want to use this type of strategy tend to be in California, where the real estate is incredibly expensive. So there's some different things you can do. So if you look at it like that, you could always exchange it into multiple properties if it's an expensive home, but you want to make it an investment property before you try to exchange it, because on a 1031 it needs to be an investment property. So you at least need to show an attempt to turn it into an investment property before you exchange it into other investment properties.
So that's a good point as well. Going back to just our capital assets or like our rental real estate, right? If we want to defer the income on the sale of that property, we can do a 1031 exchange. But it's important when you're doing a 1031 exchange that you're using a qualified intermediary so that you can make sure you don't, disqualify the exchange, right?
Correct. You don't want to receive any of the cash proceeds because that becomes boot, and any boot is immediately taxable. So if you use that intermediary to keep the cash out of your hands, you can defer the entire gain and into the new properties with an adjusted basis.
Now, when you talk about boot, what types of transactions in a 1031 exchange, other than just cash, could be boot?
Well, that's a real good question to catch me on here in a few seconds. But I have seen it many times when you have a very expensive property and maybe you're doing the 95% rule where you're getting several smaller properties.
Mm-hmm.
So maybe you don't reinvest all of the sale proceeds in all these properties. So you end up either with some leftover cash, or maybe there's some property that ends up coming to you.
Mm-hmm.
So any of that received by you, not included in the exchange, will become boot, and
So
the
you're
value of it.
partial.
Yeah, there
Okay.
could be a partial leftover because you can't buy property to invest the entire deferred gain.
Okay.
And I have seen that in that rule where you buy multiple properties, more than one or two. You might buy 5 or 6, something like that, and you can't invest that or defer the entire gain.
Now, another area where I've seen boot is with debt. So if the property that you've given up had debt, but the property that you acquired, the replacement property, does not have debt, that is considered
Income. and
income
boot.
to you.
That
Mhm,
is correct.
boot.
Part of the calculation starts with the adjusted basis on the property you're surrendering, plus the mortgage you take on, then less the mortgage that you've surrendered or paid off. So in that calculation, if you don't acquire any new debt, you
Mhm.
can end up with some boot income from that
Absolutely.
mortgage.
Absolutely. Well, you guys have anything else to add when we talk about the sale of, I mean, it's a very loaded subject, isn't it? We could go on for hours.
I think it's just important as an individual to understand your structure and what you want to do with your real estate, whether it's short-term, long-term planning, and take advantage of the capital gains rates versus ordinary income. You may want, because of losses you have, to have ordinary income. So you might have some NOLs to use up. So how do you use an asset the best for your tax situation?
So, Gary, you're saying that the client should have tax planning.
Tax planning would be a pretty good idea. Yeah.
Perfect. Well, I thank you guys so much for joining us today. I hope you got some useful information. And if you'd like to chat a little bit further with these guys, go ahead and set up a consult so we can do a strategy session with you.